This show, we're going to talk about age-appropriate investing. Different ways to do this. Today, we're going to talk about that on the Invest Well Show. If you don't know me, check me out. I've been in the game for 25 plus years. I've coached a lot of advisors. I've been on national media for about 6 years. I have a multifamily office, some other companies that we kind of do now, taxes, investments, the whole thing. And one of the things that I've learned over the years is a lot of people don't know what they want because they don't know what's available. And unfortunately, oftentimes all people see or investors see that are available is the information that they see from TV, from what they read, from social media. And so it can be tough sometimes to make good decisions as to what they should do with their investments and their wealth. Now, it's important to understand a little disclaimer because I am in the investment space. We've helped a lot of wealthy families throughout the country in many ways, that the information that I'm sharing with you today may not necessarily be specific to you. It's not investment advice. You want to seek a professional, all of that good stuff before you make an investment decision yourself. But I do want to share some things that I believe are going to be helpful for you along the way. So when you take a look at yourself, let's start with the young folks, right? Those of you that are out there that are maybe 25, 30, 35 and under, or 40 and under, I want to challenge you to think about it this way. I believe the number one goal of a younger person when they're investing is to first find out whether or not they have any entrepreneurial drive. Now, I know that sounds different than just saying, hey, let's take a look at investing X amount of dollars every single month or every single week into an ETF account or a stock market account. It's a little different. What I'm saying initially is check yourself before you wreck yourself. What happens a lot of times is you get on this path of investing into future investments via the stock market because you're limited to a lot of the things that you can invest in at your age and your wealth level. And what you don't do is maybe focus on your entrepreneurial gifts. So I want to challenge you to think about saving the money, even if that means you don't make any money on your money for a month or 2 months or 3 months or 6 months or a year, but you're saving for an idea that you want to develop and build, which is going to ultimately help you produce significant wealth. You got to know that one of the best ways to grow your wealth overall is to increase your income as a younger person. That's one of the best ways to help you develop and grow your wealth. The more disposable income you have, the more you have to invest in things that will grow your wealth in the future. So just be mindful of that little side note, which is, do you have an entrepreneurial idea that you have believed in and you've wanted to do for some time, that you need to be saving money over here, your income, to invest into something that's going to help you grow significantly more wealth in the future? Now, maybe you're in a place where you say, Mike, I love that idea, but I don't really know what I want to do right now. So here's my starting point to you. The first thing that I would say is make sure that you have enough money saved for a rainy day. Dave Ramsey talks a lot about this. I do disagree with some of his philosophy, but I do agree with the reality that you need to have a certain amount of money, your emergency fund saved 6 months at least. You need to do that. So before you go buy a new iPhone, before you go buy new whatever, make sure that you have money saved. Then you move into the idea of consistent investing over time. Don't chase ideas. Don't chase a friend that's got this great real estate deal that doesn't have a lot of wealth himself. My first suggestion for a younger person is if you're going to get involved in an investment that's a friend type investment or whatever, make sure that you talk to someone that has been successful in that space already. Hey, does this make sense? Do the numbers work? Does everything line up? Should I go there? And if they agree with it, then you're freer to say, okay, let's go do that. But if you don't find that, now you want to start some kind of consistent pattern. I do recommend the idea of not chasing stocks, especially if you're not good at it. One of the worst things that can happen for a younger person is they invest in something, whether it be options, stocks, crypto, and they make a lot of money quickly, then they think they're an expert. Now, what you don't hear on social media is the story of lots and lots of people literally blowing themselves up financially because they lost a lot of money because they thought they were a pro. They kind of backed the truck up. They went all in on something and they lost a bunch of money. My encouragement to you is to create a consistent game plan. I do like quality ETFs that have been around for a long time. But again, that's not the only thing that you want to do. When you're younger, one of the limitations that you have because your income is lower is you are limited to what you can invest in. Because certain investors that I'm going to talk about in a minute, for wealthier or folks that are close to retirement, more wealth, more money, they can invest in things that younger folks sometimes can't, because there's certain investments that are for accredited investors only. Oftentimes, the stock market or crypto or things like that is the game that many of you play. What I'm going to challenge you to make sure of, though, is make sure that you're reinvesting dividends. Reinvesting dividends back in to continue to buy and dollar cost average along the way. Remember, the stocks and prices of ETFs are going to change as time moves along. They're going to go up, they're going to go down. You want to be investing on a repetitive basis to average out your cost and do it on a consistent basis. Now, as you transition, again, and you're in a place where maybe you didn't have that business idea when you were younger, but maybe 2 years or 3 years in, you do have that business idea. I would actually use non-qualified type accounts, meaning that they're non-IRA accounts, meaning that you're taxed in a way that over time, if you take cash out, it's taxed as capital gains instead of IRA money. In the future, there's limitations. You can't take it out until 59 and a half unless you enter certain triggers, and it's taxed at ordinary income. So grow your monies and investments in ways at a younger age that maybe you don't take as much tax benefit when you're younger, but your income's lower, but you're taking money out in a capital gains basis along the way. Now, why that matters is because as you age, maybe you're 2, 3, 4, 5 years into investing, you're becoming a more learned person when it comes to investments. You've educated yourself, and now you're in a place where you can take that knowledge and you have an idea to grow a business. Well, now you have the ability with this investment account to actually pull monies out and put it towards your business. I think it's important. Now, you can also do some of these things with Roth IRAs. Obviously, you're growing tax-free monies, but there's still some limitations around Roth IRAs, so make sure you check out the details on that before you jump in. If you don't have an idea to build a business, it's okay. Still consistently do your patterns, look for ways to increase your income, and increase your monthly input every single month. The other thing that I would encourage a younger investor to do is keep your life carry cost as low as you possibly can. This is going to be something that's really hard for you to do because a lot of young people want to be in a place where they live like they're wealthy when they're younger, when they really don't have any money. They're kind of posers in a lot of ways, unfortunately. So repress your actual cost of living monthly. Live lower. Don't be in a place where you say, okay, how much can I go borrow to buy a house, to live in a great place? How much can I go borrow to drive a car? Don't do that. My encouragement to you is really think about delayed gratification. If you're in a place where you can go borrow $1 million or you can go borrow $500,000 to buy a house, cut that number in half. Allow your monthly your monthly carry cost, your mortgage, your taxes, your utility bills, etc., your car loan bills, all of these things, allow those numbers to be, or make those numbers to be as low as you possibly can make them, because you're going to be in a place where you're going to have more access to either invest for your future retirement, build a company, or all of these other things. So get your carry cost down. Don't chase your friends and neighbors that are just living way beyond their means. That's something that's so important at a young age. Let's transition now and talk about those that are moving closer to retirement. All right, so as you're moving closer to retirement, now you're in a place where your goals and your objectives start to change, or they should change. Your risk tolerance starts to change. If you're in a place where you've invested in the stock market for the last 10, 15, 20, 30 years, maybe you work for a job and you put money in a 401k, your risk tolerance needs to start to come down. Remember, you're starting to prepare for the next stage of your life. There's really only two stages of your financial life. You have the growth stage, which starts oftentimes around 17, 18, sometimes early 20s, where the goal is to start to grow wealth and grow your net worth overall. And then you have the preservation and distribution stage. Now, this could start as early as mid-30s, 50s, 60s. Just depends on where you are in your wealth journey, how much wealth you've built, and where you live. In other words, what your lifestyle is going to look like, what your cost of living is going to look like each month. But what I will tell you is in the preservation and distribution journey of life, this is where you have to think about this, because you're literally moving into what I call 30 to 40 to 50 years of unemployment, otherwise known as retirement. It's your job now to take the wealth that you have built and allow that to sustain you for the rest of your life and hopefully leave a legacy. So when you think about this, we must think differently about our risk, because now if the stock market goes down 30, 40%, we can't really sustain those massive losses. Here's the number one reason as you're moving into retirement that you can't sustain it. Because when you're working, you're participating in dollar cost averaging, meaning the markets are up, the markets are down, as we've talked about before, and you're investing along the way. So it doesn't hurt you, or let me say affect you as much while you're working. But when you're retired, you're in a completely different stage of life. What happens is you're starting to take income every month or every year or every quarter from your investments. The income that you've been putting into your investments is now stopped. So not only are you not putting monies in, you're actually taking monies out. It's one of the greatest risks to your retirement. It's called reverse dollar cost averaging. Imagine being in a place where you have simple math, $1 million, and the market drops 30%. So your value may be down to anywhere around $700,000 based on your investment stack in your portfolio. Now think about the fact that you want to take, let's say, 4 or 5% from your portfolio for income. Well, now as you take that income out, taking from the $700,000, not from the million, your $700,000 has to grow back to the million to get back to where you were. And as you're taking monies out and you're no longer putting money in, it actually makes it harder for your monies to grow back to where they should as the market recovers, which means means there is a much greater chance of you outliving your money. Now, with some of the other financial companies that I have, we work with families with millions and millions of dollars and more. And one of the things that we know is that utilizing a stock market type portfolio is not always the best from our perspective in retirement. So what should you do? Or what should you think about doing? Well, one of the things that you can think about doing is changing your complete investment structure. Remember, what got you to where you are is probably not what's going to get you to where you want to go. And it's not the idea of just transitioning and adding some bonds in either, because bonds are designed to do well when the markets are negative. Well, when you look at the markets over a 10-year period of time, traditionally markets are down 2 to 3 years. So if that's the case, if you think about this in relation to baseball, do you want to be up to bat and hit the ball 7 out of 10 times or 3 out of 10 times? With bonds, they're supposed to perform well 3 out of 10 times. But here's the challenge. A lot of bonds in seasons and years like 2008 also lost money because they're not guaranteed. So what should you do? In my opinion, one of the things that you can do to help ensure and better protect potentially your portfolio is look at investment structure off market. Years ago, I did a lot of research around the Harvard and Yale endowment models, and I took a look at what are some of the things that they were doing that other investors were not. And in some of the companies that I have, one of them in particular, we actually have a trademark investment process that's called the efficient portfolio. And it actually encompasses some of the inspiration that I obtained in researching those models years ago. I think a big thing that you need to be thinking about is how much of your money you're looking to take off market. Invest in things that are not publicly traded. Invest in things that are in demand type areas. I love quality real estate in demand type areas. What is a demand type area? Where it's a place where people are moving. Let's say there was an area, call it Florida, where there was lots of people, thousands of people every single month moving to. You know what those people are going to need? They're going to need housing. They're going to need restaurants, places to store all of the stuff that they have when they move down. In other words, there's demand. And let's say these people, when they were moving down, had wealth. And so because of that, they wanted to buy a boat. And that boat needs a boat slip. And they needed a boat slip that they were going to rent every month. And they needed to store their boat somewhere. They needed opportunities to provide for their new lifestyle. And maybe because wealth was moving down, it actually attracted more workers into that area as well, as new businesses were born. And so because younger people were coming down, maybe they were in a place where they didn't want to live in a home, but they were living in a, let's say, multifamily facility, apartments. Oh, now there's demand for apartment type building. All of these things matter. This is what I'm talking about when you look at in-demand type of investing. You can look demographically at where people are moving, where the shift is moving, where people with wealth is moving, and then look at what some of the needs are. Jeff Bezos said it this way: look at the market and look at the demand that the market is looking for and provide a solution to the demand. It's not that complicated. So when you look at investments off market, the key is, how do you select proper investments? The first thing is make sure that you're looking at something that's not long-term. The second thing is look at an investment, if it's real estate, in my opinion, that is not connected to the market. And the third thing is make sure the investor is the one that gets the win more than the developer or the builder. Now, that all comes with time and looking at project to project to see what's best, but these are all things that you need to look at. I strongly also encourage you investing in things like private equity. Now, remember, not all private equity is the same. So you can look at things off market and evaluate, how does this work? What are the benefits? How do I get in? How do I get out? Are there capital calls? Are there no capital calls? All things you want to evaluate. How much debt is being used when purchasing other companies inside of this private equity deal? All things that you want to evaluate when you're investing into these things. And there's a variety of other types of investments that you can get into, or even products that you can get into, that will give you the ability to have a more comprehensive portfolio than just stock market only. And what I've seen over the years is actually mitigate a lot of your risk, but give you a significant amount of potential along the way. By doing this in your retirement stages, it'll actually mitigate some of that reverse dollar cost averaging risk. Remember, the reverse of your money being taken out of the portfolio, but your portfolio value going down due to market only effects. You want to try and limit market only effects on your portfolio and increase opportunity where off-market investments give you the ability to have consistent cash flow, consistent values in your portfolio, and what I believe is a more comprehensive approach, holistic approach to not only your wealth, taxes, but then give you real time to think about your estate plan and create well for generations to come. Listen, I hope some of those thoughts were valuable to you along the way. If you got questions, we'd love your comments and feedback, what you liked, what you didn't like. If you have any other questions, obviously in our bio is a little bit more about me and some of the other companies that we have. If you want to reach out to them, you're welcome to do so. But please like and subscribe so you can have more content coming your way that's going to give you ideas to help make you, hopefully, a better investor and empower you to make better decisions on your financial journey. Be blessed. Talk to you next time.